Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Welcome back to the show. The show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Alan Clopine. He's a CPA. Right here, Ed Slott. You know who that guy is, Al?
I do.
Did you get this thing yet?
Yes, I got it.
Did you see that?
Yep, page 1.
What to watch for in 2017?
I got it right here.
What's the number one thing on there?
Death of the stretch IRA.
Yeah, boy.
And you just talked about that, Joe, and the stretch IRA is a way for your children, when they inherit your IRA, to stretch it over their lifetime, meaning that, let's say, this is current law, and this may go away. This is current law. So your grandchild is 20 years old, inherits some of your IRA, and then what happens is they have to take a required minimum distribution, even though they're only 20. However, it's based upon their life expectancy. So let's just say they're supposed to live 80 years. And they're 20 years old, so that's 60 years to go. So you take the balance and divide it by 60, and that's what they need to take. Now, if the stretch IRA goes away to how the law was before it, and it was probably, 15 years ago?
Yeah, 2000.
Give or take, somewhere in there. If it goes away, we're going to go back to those old rules, which means all of the money in the IRAs need to be withdrawn within 5 years, which could put your kids and grandkids in much higher tax brackets, because every time they pull money out of an IRA, it's taxed at ordinary income, just as it would have been for you.
Yeah, but here's what people think. It's like, well, my kids or grandkids, they have a lot lower tax bracket than I do. Well, until they have to pull the retirement account out.
Right.
Right? Because they'll say, well, he's in the 15% tax bracket. Yeah, to a certain level of income.
Yeah. So a simple example. So let's say your grandson or granddaughter makes $40,000 a year, and you're thinking, well, they're in the lowest bracket, so it doesn't really hurt them. But let's just say you've got a lot of money in your IRA.
$1 million.
$1 million, and they're the sole beneficiary. Okay. So under this, with the stretch going away, they would have to pull out $200,000 per year.
Or they could wait and just pull everything out on the fifth year.
In year 5
really
and do $1 million. But now they're making $240,000 a year for 5 years, which now puts them in the highest tax bracket, right? And that's the problem here with this.
Right. So then if you look at today's rates, you got 40% federal, 10% state of California, 50% gone.
That's right.
So this is why it's so important. The planning around this is key. Now, this is a proposal, but most CPA experts that Al and I pay attention to, and if you look at Congress and how they've kind of signed these congressional bills, is that it's probably coming. We don't know when. We're guessing it's going to be next year, 2017. Ed Slott said it could be as early as January of 2017.
Yeah, and he is Mr. IRA. He is. I mean, if anyone knows, I don't think anyone in the country knows more about IRAs than he does.
Probably not. Natalie Choate maybe, or Keebler.
Bob Keebler.
Yeah. And he's been on the show.
Yes, he has.
Yeah.
We couldn't get Ed Slott there.
No.
He's too busy.
Yeah, you might charge us like $50,000.
Guys, I could be on the show, but $50,000, please.
So, so be careful. I think this is a really key component because, man, there's so much money in retirement accounts.
Yeah, and
IRAs, 401ks, and everything else. And then and a lot of you are afraid to even touch these accounts, right?
Yeah.
It's like, I'm going to spend everything else down. I'm going to let my retirement plan grow and not touch it, because as soon as you start touching the retirement accounts, then that anxiety comes in. It's like, oh boy, here we are. Now I'm in asset depletion mode, where they're blowing up all their other accounts. But now it's like, okay, well, once I hit the retirement account, it's psychological.
Correct.
Be careful with that strategy. Because the bigger that thing gets, the more you're going to lose potentially from taxes. And we don't know what's going to happen in life. We could, get hit by a bus tomorrow, and if that stretch IRA is no longer, so then it's looking at a strategy of, all right, well, here I have these assets. How do I slowly drain them out? Do I spend them? Do I put them in a brokerage account? Or maybe you convert some of it to a Roth IRA. You take a look at what tax bracket that you're in, and you kind of say, all right, well, maybe I start taking a little bit off the table here. It's like tax diversification, right? Or tax rebalancing.
Yes, right.
Is another way to look at this, is to say, all right, well, here, I got this much money into a retirement account. Let's kind of do some planning here, forecast a little bit. How old am I now? How much do I have? How much am I contributing to it, or am I done contributing to it? Am I taking any money out of the account? And take a look. And then say, all right, well, maybe it might make sense for me to pull a little bit off the table and put it into a Roth. A Roth IRA will grow 100% tax-free. There is no required minimum distribution in a Roth IRA. And that if you pass with the Roth IRA, then the kids can take those dollars out tax-free. Tax-free. So it grows tax-free for your life, the spouse's life, and then the kid's life. It's very, very powerful if you do this right.
Yeah.
So then it's just kind of looking at things and saying, all right, well, don't use the status quo, right? Just it's not as complicated as it might seem. It's just looking at it maybe in a different lens.
Well, I think so too, Joe. And I think a lot of people don't realize when it comes to a Roth IRA, if for you and if you pass your spouse, there is no required minimum distribution. And if it goes to your kids, grandkids, non-spouse, then they do have to take a required minimum distribution, although it's tax-free. So currently, they can stretch that Roth IRA over their lifetime just like a regular IRA, which is great because then you get tax-free growth for the beneficiary's lifetime. But if the stretch goes away, and you're right, Joe, most experts are saying it's likely to go away next year. We don't know that, but that's what experts are saying. Then it's even more important to have your own IRA dollars in a Roth, which is tax-free, because if the grandkids have to distribute that money within 5 years, tax-free is not going to change their tax bracket. If it's still in a regular IRA, it could significantly change their tax bracket.
100% of that balance will go to the kids.
Right, exactly, 100%. So as a consequence, people need to be looking at Roth conversions right now. I think this is probably one of the most important times ever to be doing conversions. The unfortunate thing is you have to do it by December 31st for this year.
This year.
Right. We know we have this year. Maybe we have next year. Maybe, hard to know. But I think probably over the next few years, it's going to make a lot of sense for many people to get as much money they can into a Roth IRA. And I would say a lot of people also don't really understand the difference between you do a Roth conversion versus pull the money out and spend it versus put the money in a brokerage account. It's all the same. It's the same tax no matter what you do with it.
It's just the dollars.
It's the dollars, right? So you pull out $10,000, whatever tax bracket. Let's say you're in a 40% tax bracket, $4,000 tax. That's true whether you spend it, whether you put it in your savings account, whether you do a Roth conversion. It's the same tax. But if you're not going to spend it, wouldn't I rather have that money sitting in a Roth IRA, which grows tax-free, as opposed to my savings account or brokerage account, which I'm going to have to pay taxes on earnings and growth in the future? It's kind of a no-brainer when you think about it that way.
Right, great point. And then I know we're talking about the stretch and, passing to the wealth of the next generation. A lot of you are saying, well, I don't have any kids, or you know what, I don't really care for my kids. Maybe some of you are.
Yeah.
But it's going to benefit you long term, because then it's going to give you the tax diversification that you need to create the income that you need.
Yeah, and that's such a key point,
right?
Joe.
And so the first point when you look at this, it should be you and your family of, all right, well, it's my retirement. How do I create the income that I need from my retirement? And then if there's something left over for the kids, that's great, but that's not my main focus. That's what a lot of people, I think, that come through our office, that's, hey, it would be nice if I left them some, but I'm not going to go broke to make my kids rich. So, but still, when doing Roth conversions, it's going to help you out immensely. But then, God forbid, if you pass, prematurely, then it's not going to, do all that hard work that you build up, that cash. It's not needlessly going to go to the IRS.
Right. And the reason, Joe, is because taxes don't stop when your paycheck does.
They sure don't.
You got to keep paying taxes, unfortunately. I know it's a sad fact. 70 years old, 75, 80, 85, you're still paying taxes. If you're not retired, you'll learn. Your retirement nest egg comes with all sorts of new rules, but also opportunities. Instead of contributing to those retirement accounts and creating a tax deduction, you start pulling money out and for income and paying taxes at your regular rates, unless you're tapping into a Roth IRA. This is so important. If you can have some tax diversification, some money in a Roth IRA, you can have some of your income each year coming out of a Roth, therefore staying out of some of the higher tax brackets. And as you near retirement...
All right, we got to take a break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. Your money, your wealth. Alan, I got some questions here for you.
Really?
Yes.
Okay.
Unless you got some earth-shattering news that our listeners need to hear.
No, I think we're ready for questions.
Good, because there's some doozies in here.
Oh, good.
So this is the email bag. Once a week, we go through some emails, and sometimes it takes us a couple of minutes, and sometimes it takes us a couple of hours to go through this. And this is through Investopedia.
Okay.
If you've ever been to Investopedia, you could go there. But they asked me, there's the email I got right here. Hello, Joseph. Below are a few of the latest questions that have been submitted from investors with your areas of expertise.
Oh.
So...
They're looking for you to answer them.
Yes, sir.
Have you seen these questions, or this just reading them right up the sheet?
No, they print them out when I walk out the door.
Okay, cool. Yeah, and
I study them.
Well, I'm just asking because I haven't seen them.
No, that's the fun of it.
I know, and I think our listeners need to know that. That's why that's why we stumble so much.
Just in case you blow up, you're giving yourself an out.
Already, I've got my excuse.
Yes, excuse to
because I've heard another financial radio show where they kind of make fun of it, but they say, well, it's we don't take live callers because he only wants to answer the questions he knows the answers to. No, we just ask any of them.
Whatever.
Yeah. If we don't know it, we'll say we don't know it.
I was listening to this podcast, and it was the most interesting question. It was, I've contributed to a Roth IRA or something like this. So this is going off of memory.
Okay.
All right. And so it was like, all right, well, I've been contributing to a Roth IRA over the last couple of years. Can I move that Roth IRA into a traditional IRA and then claim the tax deduction?
Oh, that is a strange but interesting question.
That is the stupidest thing I've ever heard.
The answer is no, by the way.
Yeah, it's like, okay, well, what are you talking about?
Because now I'm in a higher bracket. Can I take that deduction that I didn't take before?
Right.
I like the thinking. It's creative.
And then so the answer was, well, yes, only if you're broke.
What?
I was like, wow, this is good. This is a really good information here. I'm like, where's he going to go with this?
Yeah.
And then he started stumbling a little bit.
Because it was already false, his first statement.
And it was like, oh, gosh, oh, man. Well, then he's like, well, yeah. And then the other guy in the pot, he's like, yeah, I have no idea. I have no idea. He's like, yeah, you can. Only if you're broke. But think about it, right? So there's a Roth conversion. So that's when you put money into a retirement account. You take the tax deduction. And then when you move that money into a Roth IRA, you pay tax. Mm-hmm. By the conversion, and then all of that money will forever grow tax-free.
Right.
All right? So we talk about Roth conversions. If you've ever listened to 5 seconds of this show, we probably said Roth 15 times in that 5 seconds.
Probably.
But this is the opposite of saying, hey, I have a Roth. I didn't take the deduction. I have all this money growing tax-free. Can I move it into a traditional IRA to blow myself up in tax?
Take that write-off.
And get the write-off.
Right.
What you could do, and let me see if you agree with this, Al.
Okay.
I make a Roth IRA conversion for a contribution. Mm-hmm. Roth IRA contribution for 2016. Okay. I have until October 15th to recharacterize, but I have until April 15th to make any type of contribution of next year.
Yes. True.
So I could potentially recharacterize the Roth contribution and then contribute to an IRA.
Sure.
That would give that same effect in that time frame.
I agree with that. In other words, if it's still within that same time period. In other words, you made it in 2016, and you could recharacterize it all the way to 2017, or October 15th of 2017.
Yeah, but you would have to make the non-deductible IRA contribution for 2016 before April 15th.
Correct.
So you would have to do the recharacterization and contribution before that date versus the October date.
At the same time. That's correct. Yeah, I agree with that. Or if you're broke, you can always pull out your Roth contribution regardless of what age you are.
Sure.
No tax, no penalty. No one knows that, Joe.
Right.
32 years old. You listened to our show. You did a $5,500 Roth conversion.
Contribution.
Contribution. Thank you. And next year you lose your job. Okay, that $5,500 is going to $6,000. Well, you can take the $5,500 out, no tax, no penalty. If you take that $500 of growth, tax and penalty. So try not to do that. But you can take your contribution out in an emergency.
Anytime, any age, no tax, no penalties.
Right.
You make $5,000 one year, $5,000 the next year, $5,000 the next year, $5,000 the next year. 4 years of contributions, $20,000 in the account. The following year, you need $20,000. Well, you could pull that $20,000 out, no taxes, no penalties, no harm, no foul, any age, any time.
Yes, and we don't recommend it.
No,
We'd
never.
rather have you keep it in the Roth, of course. But worst comes to worst, that's available. So if you're broke, no, don't put it into the IRA and get a deduction. First of all, it's not allowed. Secondly, you don't need the tax deduction.
Here's
Okay.
one from one of our younger listeners, but it's not to us. I forgot. I'm in a 30-year fixed mortgage with Wells Fargo, Alan.
Okay, yeah.
There has been several financial criminal incidents regarding Wells Fargo this past year.
Okay.
Could my mortgage be negatively affected by this, as well as the interest rate hike? What's your comment?
The answer is absolutely not. A fixed mortgage is a fixed contract. So whatever the interest rate was when you took it out is your interest rate for 30 years, regardless of the institution, number one. Number two is...
But all right, so let's take a look at, let's carry on with that.
Okay.
How long do you think the banks keep that paper on their books?
Well, that's the second point. They probably don't even own it.
Right.
They're probably servicing it, but it's probably part of mortgage-backed securities and investment that we can buy.
Right. So what they do is banks, the mortgages that they do, they don't keep them on their books. They package them up in a,
Yes.
CMO, CDO, or
all
mortgage-backed
that
security
stuff that
blew
brought
us up.
our economy down. In and of themselves, those are not bad. There were abuses in how those were set up, and if you want to know how that happened, go watch The Big Short. That explains it better than we can.
Yeah, there's some tranches.
But yeah, so right. So the contract that you signed with Wells Fargo is a fixed contract. You have a fixed interest rate. There's absolutely no way to change it. And plus, Wells Fargo probably doesn't even own the loan anyway.
What about interest rate hike? Well, that will probably affect future lender
but not
or
yours.
borrowers, but not yours.
That's the whole point of getting a fixed mortgage. And as a matter of fact, since interest rates were raised up by 0.25% and will likely continue. I mean, that's what they told us. That's what Janet Yellen said. She'd like to raise it maybe up to three more times in 2017. So what does that mean? That means mortgage interest, it's not directly tied to it, but there's an indirect relationship. So
it's the Fed funds rate. That's what they're raising. I think most people don't know what the heck the Fed funds rate is.
Not.
It's what banks lend each other on the overnight rate.
Right. But probably mortgage rates will go up, and if you've got a variable rate, you might want to get a fixed rate loan right now. That's actually the takeaway.
Take a break. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner professional. I'm with Alan Clopine. He's a CPA. We're got into the email bag.
Yes.
It's kind of like a stocking here, just full of questions.
I think we answered one question last segment. Let's see if we can do another one.
All right. The difference. Yep, I knew before I opened my mouth. I should have knew what I was going to tell you.
Okay, you don't have to. You can stop right now.
No, it has something to do with like being afraid, courage, cowardness, and courageousness.
Okay.
Is that everyone's afraid, right? And so this is the trainer of Mike Tyson.
Okay.
I guess Mike Tyson, before he went to a fight, he was really nervous and he was anxious and it was like, well, everyone has those feelings, right?
Sure.
It's just what you do with them.
Right.
So when you have that feel of fear, right? So how are you going to harness it? Are you going to harness it and run away, or are you going to harness it and move forward?
Right. And use it for good, right? Or use it for positive.
Exactly.
Yeah.
So
okay.
Everyone has fear.
Right.
So it's not like here, if I have fear, then I'm a coward. No, everyone has fear. You could be courageous with that same fear. It's just how you harness it.
Wow, this is deep. Look at you.
You like that?
I do like it, and I completely agree.
Yeah, because I mean, I try to push myself to the limit every single day, and so do you.
Right.
And I think a lot of people, and some of our employees, since it's the holiday season, might not do that. Just kidding.
Well, it's funny. You and I have talked about this before, and I remember early on in my young career, I thought I might be a park ranger, and I actually worked a couple summers in the state park in Idlewild, San Jacinto, and I was doing campfire programs every night, and almost virtually every night I would get butterflies, and I was thinking, it doesn't seem right that even after like 3 months, I should be having these butterflies. I did though, and I found it really helped my performance. And you're right, it's actually how you harness that.
Great story. Hey, boo-boo.
Well, you started it. What's your story? How do you harness your fear?
I was a park ranger. I had this hat.
I did.
Khaki shorts.
Oh,
and your boots.
You're so jealous.
I could just see Clopine.
I got to drive the green truck.
Could you imagine?
And I got to get, like, if you didn't have a permit, I could.
Ranger Rick, right?
Yeah,
Wasn't that
yeah.
the Ranger from Yogi Bear?
Yeah.
Okay, this is a question for you. Why is it difficult for me to get benefits as a mother caring for a mentally disabled son? I met all the requirements online. As a matter of fact, after I took the questionnaire on the Social Security website, it stated that I would qualify. However, my local Social Security office keeps giving me a hard time. What is your suggestion there? Probably should have read this one.
Well, I don't have a great suggestion other than, Joe, I have heard that to get Social Security disability payments is a lot harder than you would think, and I know that's not helping you very much, but I don't have a great answer right off the bat.
And I think, too, it's like you got to keep trying. You got to keep talking to different people or go up the chain.
Yeah, and the thing is, and we know this to be true, that depending upon who you talk to, you might get a completely different answer at the Social Security Administration. And this isn't a slam on them because it's very, very complicated, and you might have someone more senior or less senior that really doesn't understand the rules as well.
When the rules changed this year, right, with file and suspend and restricted application, we met with several clients right before the deadline. A lot of you listeners, too, came in.
Right.
And so there were certain things that you had to do before certain deadlines. And so we would say, okay, well, here's your strategy. You file for your benefits. You suspend them. Okay, you claim your restricted application, and laid it all out to them. So then they would go call their Social Security. Nope, you can't do it. And then so it would come back to us. It's like, well, no, they said that we can't do it. What do you do? It's like, no, you can do this. This is the, right? Then they go back. Nope, you can't do it. Then finally, all right, let's do a conference call together. And, so we would have to go 2 or 3 different times just to talk to the right person. And it's like, oh, yeah, sure, you can do it. So I guess our advice with anything is that if you feel that you're entitled to it, just continue to go up the chain.
I think that's good advice. Another story, Joe. This was probably 3 or 4 years ago. When file and suspend, there was nothing wrong with it. You could file and suspend, and your spouse could take spousal, which is half of your benefit. That was completely legit. We had a couple that they were both 68 years old,
yep.
and neither one was doing anything. And so we told them what to do. They went in, same thing. They came back, well, you can't do it. It's not allowed. And I said, oh, my goodness. So I said, all right, here, I am going to email you. And I scanned it right off the Social Security's website. Here's the rule, and here's what you can do. And he took it with him to the next time. Interestingly enough, he didn't even have to pull it out of his briefcase because he got someone that understood it. Signed up, no problem. Right?
It's just a pain. I mean,
is.
Going to the Social Security Administration office is like going to the DMV. I mean,
it's probably worse than that, but like the dentist.
All right, here's another one. I recently changed my job. My new employer offers a 401k plan,
okay,
but only after I've worked for a certain number of hours.
Okay.
So technically, I cannot contribute towards any retirement account. So as to reduce the tax, can I contribute towards my spouse 401k and max out his contributions? We file taxes jointly.
Oh, that's a great question. Well, no, you can't directly contribute to your spouses, but here's what you can do, is you can have your spouse put more into their 401k, reducing his or her paycheck, and then you have more coming out of your paycheck, and you just balance it out that way.
Right, I guess
same effect.
Yeah, I guess. Well, the only caveat with that is that you have to ask. All right, well, is your spouse fully funding the 401k plan? If they're maxing out the 401k plan, then no, then it's maxed out. So if they're putting in $18,000, you cannot put any more than that unless you're over 50. Then you can put in $24,000. So let's say your spouse is maxing out the plan. You cannot then piggyback off of his plan or her plan, whatever the case may be here.
Yes.
But like you said, Al, that's perfect. Is that all right? Well, maybe they're only putting in $10,000, and you were thinking about putting $10,000 into your plan. Well, we'll just have the spouse then put in $20,000 out of their paycheck. They're going to have a lot lower paycheck, but then you just have added cash flow because you're not saving into your plan. Then you get into the funny business of, okay, well, what people like have their income and investments totally separate.
And right, that makes it a little bit trickier. But now, of course, you said 20,000, and you can actually do 24,000 if you're over 50. But if you're under 50, it's 18,000 max. But here's something else, Joe, is that your spouse is in a pension plan, and as long as your joint income is less than $184,000, you can either, and you're not in a pension plan, you can either do a Roth contribution for $5,500 or a regular IRA contribution and take a deduction. So maybe that's enough. Maybe $5,500 is enough in this case.
All right. Well, let me see. This one should be interesting. Will a financial advisor provide an unbiased assessment of a financial plan I already have in place? All right. Summary of the email. I already have an investment advisor connected with an insurance company who handles our investments.
Okay.
I would like to have an independent financial advisor who can provide an unbiased assessment of our financial plan and investments. Is it possible that an advisor would provide this service, and what fee might be expected?
Yeah, that's a great question. Well, I guess, Joe, I might start by saying there are advisors that are fiduciary, meaning that they're required by law to act in your best interest. And then there are advisors that are what fall under the suitability standard, which means they can sell you anything that's suitable for you, which isn't as strong a standard as fiduciary. So yes, you can find an advisor that will give you unbiased opinions, but you probably want to go to a fiduciary, I would say. What they will charge you, it varies all over the place. And some will take a look at your situation for free, hoping that you'll change and use them as the advisor. Others will charge you. I think, honestly, to me, the best financial plans that you can get from an independent fiduciary advisor, you're going to need to pay for, because then it really is unbiased. What it could cost $500. It could cost $10,000. It just depends upon the firm.
There's always going to be biased, is my thought. There's always going to be biased. So with this, it's like, all right, well, let me go to a financial advisor. So he or she is working with an insurance agent.
Yes.
And I can see where they're like, okay, well, maybe I want to get an unbiased opinion here. Right. So then you have to ask, all right, well, how is that unbiased advisor that you're searching for compensated?
Yes.
All right. So are they compensated? Do they manage assets? Do they just do a fee-only financial plan that does not manage assets? Do they charge by the hour? Do they charge by the retainer? And things of that nature. So you have to dive in deeper here, I think. Because let's say that I am a fiduciary, Alan, right? But I get paid on maybe 1.5% or 1% of the assets that I manage. So then you come in, you show me your financial plan. Even though I'm a fiduciary, what's my bias?
Yeah, there's definite bias.
Even though that person is going to probably say, you know what, you're in this or that or whatever, here, I have another plan.
Right.
I'm not saying it's good or bad. It's going to be fairly difficult. What I would suggest this person to do is say, all right, well, here, I just want a full review. I do not want anyone to manage my assets. So make sure that advisor knows up front. I would like just a full review or another financial plan. I would say then a good cost of that would probably be $3,000 at minimum.
Right.
And it depends on the assets. I mean, if they got $100,000, I mean, maybe someone would do it for something less than that.
Right. And I agree with that assessment, Joe. It's just sometimes it's hard to think that every single person out there has a bias, but unfortunately that's a reality of being a human.
Right.
Right? Every person you talk to, every article you read, right, in the paper has a bias.
Sure. I mean, if I'm an insurance person, I'm going to look for an insurance opportunity. If I'm an investment guy, I'm going to look for an investment opportunity.
I just think that there's a much better chance of having a better, more unbiased opinion with a fiduciary than someone that's not a fiduciary.
Yes, of course. Because then it's like, well, then how are they compensated? Are they compensated via commission? Are they trying to sell you a product? Well, you're not going to get any unbiased information there at all because they wouldn't know what to look for.
For example, you could go to another insurance company that says, oh, yeah, we do financial plans for free.
Sure.
And then what are they trying to sell you?
Exactly.
And honestly, what they may be trying to sell you might be great, right? It might be fantastic.
But you have to go in there and say, hey, I need help. I'm looking for an open opinion, and then just make sure that open opinion is as, I guess, comprehensive as possible.
Right. That
they are going to take a look at your cash flow in regards to, all right, well, how are you collecting your Social Security benefits? What's the taxation of the Social Security benefits? Should you claim now? Should you claim later? Do you have a pension plan? How is that encompassed in the overall retirement income strategy, right? Do you take a lump sum? Do you take the pension? Do you take a single life? Do you take a joint life? Do you have life insurance to cover any type of shortfall when it comes to death? Then you have to look at the tax implications of the income that you're receiving. Do you have any tax strategy now and in the future? Are you looking to do, how are they managing the assets from either a tax-free component or a capital gains or ordinary income? Do they understand the impact of the taxation of the investments that you have? Then you have to look at the investments itself. What is the risk? What's the return? What's the fees? What's the cost? What type of products are you in? What's the estate plan look like? How does this all coordinate together? And if they write that all down in writing and say, here's the good, the bad, and the ugly, then you could take that and say, you know what? Yeah, maybe I should switch advisors. Then you go and then, do whatever. But I think it has to be more comprehensive versus saying, hey, can you take a look at my plan? Most people are going to say it's garbage. Work with me.
I would agree with that.
Right?
Yeah, and I think, unfortunately, to get a good unbiased plan, it's going to cost you some money.
Sure.
Yeah, right. And $3,000, that's probably a good figure. Could be more, could be less, but that's probably
with written recommendations.
Right.
Dive in real deep.
Agreed.
Right.
Yes.
And I would say because we do free consultations, we do free tax analysis, we do.
Yeah, we do.
But we're not spending 40 hours on this.
Right.
We'll spend a couple of hours, and we understand that we're losing money on it, but we're fine with that because then we can show people exactly what they need to do. That was our whole mantra when we came up with this, and so it's all detailed. It's in writing, and then they can say, all right, well, my advisor is doing this, they're not doing this, or maybe I can do this myself, or maybe it might make sense for me to hire an advisor. Give the person the opportunity to understand and the education behind it. I think most people need a good, comprehensive financial strategy, but I agree with you 100% that person should be a fiduciary. They should be a fee only. I mean, if they're commission or fee-based, whatever, as long as they're competent and you understand the commissions and how you're paying for that advisor, I think it's fine because it's not necessarily about the product too or the fees and the cost. It's about someone being competent enough to help that individual in good times and bad times and have the right strategy in looking forward and making sure that they can coach them through really bad times.
Right, agreed. And Joe, that's one of the tough things about our industry is there's many good advisors and there's some that aren't as good, and you just have to be careful. I think what you hit on something really good, which is when you talk to somebody that you're considering being an advisor, ask them how they're compensated.
Right, and I mean it's so foolish for us to talk about because you and I are advisors.
I know.
We have a bias even talking about
It's already
this.
biased, which makes us uncomfortable. But
Alan's like, oh God, do you really want to say that? Yes, I do. I'm transparent. I don't care. All right, we got to take a break. When we get back, we're going to wrap this show up, right? Are we done?
We're done next after this.
We're almost done. All right. The show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, Big Al Clopine, CPA. Thanks for tuning in. Happy holidays, everyone. I know we're kind of winding down the year. We're just kind of getting things roaring up for end of year, and then, of course, 2017. Want to thank everyone that went to our tax workshop. Was that last week already?
It was last week.
Last week.
Yep. We had one on Tuesday and one on Saturday.
Thank you, everyone. And we have a recap of that show. We have a quick 10-minute video, I believe, of Alan going through kind of the proposed changes. Then we have a full, 13, 14-page or 12 to 13-page white paper.
Yes.
It's a lot of pages.
It's don't get tripped up with compliance.
You're right. There's more than one page.
Joe, it's not 14. It was 13.
13, right. I knew it. As soon as I said it, I didn't know the number. All right. So let's see here. We got a couple of questions that came through from our tax workshop, Al.
Oh, good. Okay.
And let's go with this one. Can I move money from a retirement account to a Roth IRA? And what is the process like? Tax ramifications.
Okay.
Do I have to move it all?
Okay, good question. Let's retirement account. So am I going to presume it's like a 401k, let's just say?
Sure.
I'll go with that. So yes, you can take money out of your 401k. It depends though, your age, right? And it also depends upon whether you're working or not. So
Well, let's just say it's an IRA. If you have an IRA, you can convert that at any time.
Yeah.
If you have a retirement plan that you're still an active participant in, then you have to kind of
well, then you'd have to have an in-service withdrawal if you're over 59 and a half. But the concept is this. We'll make it simpler, Joe. Good point. You got money in an IRA. Can you convert it to a Roth IRA? The answer is yes. You can convert it. What's the ramifications? You pay ordinary income tax on what you convert. If you convert too much and put yourself in a higher tax bracket, you can recharacterize all or part of that. And finally, you do not have to convert the whole thing. You can convert any dollar amount you want to.
I am a government employee and have a TSP. What is the difference between that and a Roth IRA? A civilian Roth IRA and TSP?
TSP. You answer what a TSP is.
Well, TSP is a thrift savings plan, and that's offered to government employees. It's just exactly like the 401k plan or 403b, whatever. And then what's the difference between that and a Roth IRA? Well, you could do a Roth TSP. That's an after-tax contribution that grows 100% tax-free. Roth IRA is an individual retirement account that you can contribute tax-free. It's just the contribution limits are different. On a TSP plan, thrift savings plan, you can do $18,000. If you're over 50, you can go 24. In a Roth IRA, it's $5,500. If you're over 50, it's another $1,065. You have the full universe of choices in the IRA. The TSP has 4 or 5 choices. The 4 or 5 choices in the TSP, however, are very cheap, good investments.
They're low cost.
Yeah,
aren't they?
low cost. It's fine. You have major food groups there, so I wouldn't necessarily worry about it. So, and you can do both. If you want to put money into the TSP into a Roth IRA, you can absolutely do that as well. You can double up. Most people think, hey, since I'm contributing to my retirement account, I can't contribute to my IRA or Roth IRA. The answer is false. You can absolutely do both. Hey, well, join us next week. I'll give you the inside scoop to see if Alan followed our directions when it comes to office etiquette at a holiday party.
We're going to review how I did?
Yes, we'll have a secret camera, and we'll put that up on our TV show coming up, season 4 in January.
Perfect.
So next month, we'll have season 4 of Your Money, Your Wealth, so stay tuned for that. If you've never seen an episode of the TV show, you can go to yourmoneyyourwealth.com, yourmoneyyourwealth.com. It was ranked the #1 show 2 years in a row by my mother.
Yeah, at 6:30 a.m. in San Diego.
Yes, she voted it the best show, best financial show in San Diego at 6:30 in the morning.
Right.
On CBS.
And the only one.
The only one.
But we got that going for us.
Yeah, we do have that going for us. All right. Well, happy holidays, everyone. We'll see if what we get next week, actually, because I think it's Christmas Eve almost next week. So you might get a best of.
might
You might
do a
get
best
us.
of.
We'll figure it out.
Yeah, right.
All right. Happy holidays. We'll see you soon. Show's called Your Money Wealth. For Big Al Clopine, I'm Joe Anderson.